much, everyone, for joining us today for the first day of our 4-day DACOM DeFi series, jointly brought to you by Crypto Compare, Solidus Labs, Securrency, and the Global Digital Currency Association. We've titled this event Rising Tide, Challenges and Opportunities for Regulated Decentralized Finance. And each day over the next 4 days will bring together some of the industry's foremost thinkers in the DeFi movement, whether they be from leading projects and digital asset trading venues, traditional financial services firms evolving to embrace this new evolution, or regulators seeking to bring clarity and transparency amidst a maturing and evolving financial landscape. My name is Alyssa Ostrov. I'm the Chief of Staff at Crypto Compare, a leading provider of digital asset market data and indices. This event has been many months in the making and would not be possible without the tireless work of my fellow co-organizers, Chen Arad, who is the Chief Operating Officer of Solidus Labs, a category definer for crypto market surveillance, offering the first crypto-native risk monitoring hub, Jackson Mueller, who's the Director of Policy and Government Relations at Securrency, a leading developer of institutional-grade blockchain-based financial and regulatory infrastructure technology, and David Carman, who's the co-founder and board member of the Global Digital Currency Association, a self-regulatory association for the crypto industry. The format of this event is a 30-minute keynote fireside chat, followed by a 1-hour panel discussion, each day covering a unique facet of the decentralized finance and digital asset ecosystem. In today's session, discussing what's next for DeFi, we'll first hear from Sam Bankman-Fried, followed by a panel discussion moderated by Cami Russo of The Defiant and featuring an amazing lineup of speakers from Aave, Alchemy, Consensus, and Balancer Labs. If you haven't yet signed up for the rest of this week's events, you can join us at the same time every day with our final session concluding this Thursday. Tomorrow, we'll focus on DeFi regulation and institutionalization, featuring CFTC Commissioner Dan Berkovitz as our keynote speaker, preceded by a great panel of speakers from State Street, Wisdom Tree, and Securrency, moderated by Noel Atchison of Genesis Trading. So without any further ado, I'd like to introduce today's keynote session featuring Sam Bankman-Fried, the founder and CEO of both FTX and Alameda Research, moderated by Asaf Meir, CEO and co-founder of Solidus Labs. Asaf, I'd like to invite you to take things from here.
Thanks, Alyssa. Excited to kick off this week events here with Sam. Sam, thank you for joining us. Really happy you're here. I know it's quite late over on your side of the globe, so appreciate it.
Yeah, thanks for having me.
Absolutely. So how about we start with something light-weighted, considering the time. So, as Alyssa mentioned, DACOM event is a very much about DeFi and crypto with a focus on the role of regulation and institutions in it as a key main driver. Now, taking a different angle, one of the key drivers I wanted to ask you about was your recent sponsorship of the Miami Heats, now the FTX Arena, and the most even recent partnership with Tom Brady. Now, granted, I am originally from Israel. I don't know much about American sports, but even I know that Tom Brady is a big deal. So I want to ask you about that. Is it all just fun, or is it, in your view, a main driver for kind of mainstream adoption for crypto and DeFi?
Yeah, I think you kind of hit the nail on the head there when you said that, you're not from the States, but even, he's a big deal. I mean, I think that's exactly what we were shooting for. And, I think it is a big piece of adoption for us. And, what we're shooting for there is, what are the things we can do that can get tens of millions of people to become aware and engaged, especially in a way that doesn't dilute our brand too much, that doesn't seem just sort of rote. And, obviously you could buy tens of millions of Facebook ads. I don't know, maybe it's correct, maybe not. But we wanted to try and find something that would hopefully be a bit more engaging than that.
Got it. No, I mean, yeah, that makes a lot of sense. Exactly. If I heard about him, then the reach was quite vast. I want to even take this further into the decentralized aspect of things. we like speaking a lot about decentralization. It's a lot of our work here at Solidus. But in practice, most of trading today is centralized, including at FTX. And the key topic for this week is really whether DeFi will go CeFi or CeFi is going to go DeFi. And as someone who is, serving millions of users on FTX, but also recently launched Serum on Solana, you're in a really unique position to try and answer that. Love to hear your thoughts there.
Totally. And I think that the big thing that, when I think about this is, basically like, what are the core advantages and disadvantages of different systems? Who knows exactly what will happen, but at least you can map out what could happen or it might make sense to happen. There are a lot of big advantages to DeFi. When you look at the composability of different programs, that's absolutely huge. And it means that you can get sort of exponential growth of the ecosystem in a really native way. There are a lot of cool things going on there. There are also some downsides to it that I think people don't talk about that much. What are the downsides? Well, right now you can talk about the regulatory aspect. That's potentially, it's uncertain and addressable. So I'm going to sort of put that aside, although that is something that both regulators and industry are going to have to kind of cooperatively figure out what the plan is for. But
Sam, maybe I can interject here. When you're speaking about regulation, I want to, obviously it's a big topic internally at Solidus, and I want to separate things here. There's regulation that is usually mandated by governments, right? And then there's regulation, in-house regulation that we are seeing a lot of the market participants pushing for in order to protect their users from bad behavior. And and when it comes to DeFi, it's an interesting conversation, right? Whether market operators should be responsible and have their users' backs in case something bad takes place.
It's super interesting. It turns a lot of scripts on their head, and it's not obvious if it's good or bad necessarily, but it's different, right? And it's like you replace one sort of risk for another. You completely replace the sort of like bad actor risk of the designer of the protocol, or at least mostly replace that. But instead you have like bug risk, which is way harder to address, right? And you have, if someone makes mistakes somewhere, it's often way harder or impossible to fix in DeFi. And so I think that those are all super interesting questions. I don't think that's necessarily going to, determine the long run fate of DeFi, though I do think it's a very large impact on the short run. But these are sort of addressable. I think there's sort of a few very hard to address things. And they get down to really the core computational efficiency of different protocols, where if you have a geographically decentralized consensus mechanism, it takes 100 milliseconds for light to travel around the world. That's a very hard thing to sort of like, going faster than the speed of light is not easy, shall we say? And so what this means is that it's very, very difficult to imagine a truly decentralized protocol with a latency of less than 100 milliseconds. It's also hard to imagine a truly decentralized protocol that isn't spending at least 100 to 1,000 times the minimum necessary amount of compute. Because again, you want to have a ton of different validators or nodes or miners or whatever you're calling these people, each independently calculating out the entire blockchain, right? Not just one central server. So what this means is it's not a good fit for things that are very, very strongly kind of like bound by compute, where just that's a big factor in determining how well they work. And so what does this mean? It means posting a link to a video on a DeFi protocol, totally fine, absolutely trivial. Posting a video itself on a DeFi protocol, very difficult, because it's just so massive a file, right? And then when you look at the trading realm, Robinhood type applications, absolutely fine on DeFi. There's an extra half-second of lag when you swipe right on those. So adding 100 milliseconds, not a big deal. When you look at two HFT firms trading with each other, 100 milliseconds is an eternity. And so I think what that means is just that, like, I think the real big upside of DeFi is that like a decent chunk of the world's businesses will run on it. Not all of them, maybe not most of them, but a pretty sizable number. I mean, that would be absolutely massive. We're talking tens to hundreds of trillions of dollars of value from that. But I do think that like when you then get to the question of DeFi versus CeFi, of like which type of exchange will win, I think there's always going to be centralized exchanges, at least in some respect, because for some of the trading that goes on, you actually need to have a single centralized server, but not for all of it. And so I think that's sort of like the upside of DeFi is that it captures some significant chunk, although certainly not all of that space.
Yeah. So, it's interesting what you're saying. There are, concrete trading technical capabilities that need to be developed in order to usher in this type of kind of mainstream decentralized adoption. And then I know, Solana is developing a lot around its parallelization for scalability, being able to process multiple orders at the same time, not sequentially. And so, assuming that's all solved for, right? All those technical patches are being put there in 10 years. So I hear you often speak about this vision of being able to have 100x volumes on decentralized finance. But what does it mean for the retail, accredited, and institutional investors day to day? I mean, quite literally, what is that vision? Or I would ask, what is your ideal outcome of that? When you were deciding about Solana, what were you thinking? What was your vision there?
So first of all, I think the most ambitious vision has to have at least 5% of the world's economy running on chain. Like, I think that is theoretically doable, probably bigger than 5% is. And so if you're sort of like, you've got to be shooting for numbers that are at least that big in sort of the real upside cases, not saying you necessarily will reach them. And then what's that look like for the actual users? Hopefully it looks like, 1 billion people globally or more are using DeFi, and that there's an absolute explosion of applications on it. And that there's a huge, huge variety of them. And that it's, when you think about an entrepreneur, that the easiest way to launch a business is to put a decent chunk of it on chain, because you get to build off of what everyone else has, right? If you want to build your retail trading app, by far the easiest place to start is to design a new trading interface on an existing DEX, because that is easy. That you don't need, like, it's all a completely well-defined protocol that you can build on top of. And so I think you see a lot of innovation happening, a lot of composability being taken advantage of with that, and just a lot of new applications coming out. And I think, people talk a lot about retail trading. I think social media is another obvious example here, where right now we're fractured between 50 major social media sites worldwide. And if you tweet something, no one can see it on Facebook or Weibo or WeChat or Line. But these all have the same underlying protocol, right? Which is just like a way to send a message to an encrypted message that some specified set of people can read. And what you can imagine is an underlying protocol that all of these draw from, where there's some basically encrypted social messaging protocol, and then everything else is a different sort of taking GUI on top of that and user experience on top of it. But it means that you don't lose your data when you go from one to another, or you can specify the extent to which that happens. But if you want, you can send a single message that's accessible on exactly whichever set of platforms you want it to be accessible on. And it means that it's easy to launch your own, it's a permissionless bottom layer. And then if you want to launch a moderated version, it's easy to do so. If you want to launch an unmoderated version, you can do so. There can be different types of moderated versions depending on what people want there. And they're all composable. And so it's not like you have this giant networking bottleneck that stops a new version from having any value, because it already gets to draw from the existing corpus of material. And so I think that's like another sort of exciting vision for what could happen with an industry on chain.
Yeah. I was impressed with in one of your recent interviews. You mentioned how you have something that ICE or NYSE or NASDAQ doesn't have, and that's a very active Twitter user base that keeps tweeting at you kind of what they want. They wanted lumber futures. You had it within a few hours. I wanted to ask, when it comes to, and we touched upon this slightly earlier, but I want to go back to that. In terms of what's the role of, and I'll put aside regulation, but what's the role of risk mitigation as it comes to decentralized finance? and whether you've seen this type of push coming in from users, from folks that are trading here and on decentralized finance protocols. What is your view there? Are you seeing that coming up?
So it's a good question. And one thing that I will say is that right now, and this may change, but today, most of the users of DeFi are very highly engaged crypto users. It's not a mass audience, kind of new user acquisition funnel right now. These are people who know their way around crypto. And that changes the conversation a lot, right? These are sophisticated users who know what they're doing, who understand the trades, that they understand, they're power users, right? And there's BSC is a little bit different here, because BSC's natural crowd to some extent is DeFi, but to some extent it's Binance users. Binance has a massive user base, much bigger than all of DeFi put together today. And many of them are much newer users. And so when you look at like applications on BSC, we see a lot more people asking very basic questions. When you look at basically any other active chain right now, people know what they're doing. The questions that we get asked are remarkably sophisticated. And so when you talk about things like, security, safety, how easy it is to brick your funds accidentally, everything like that, it's just a less big concern for these users because they really know their way around. But, and this is a big but, when we see people who have never really done much crypto before try out DeFi, they have a miserable experience. It's really bad. And a lot has to be done on that.
And how does that relate or apply towards institutions you might be talking with?
Yeah, it's a good question. The answer is they're very excited by the idea of DeFi. Most of them have never tried it. When they do try it, they're like, Jesus, this is not ready. It's like a very negative reaction when they actually try DeFi, but very positive when they hear about it. And so what you'll see is that when they're staying in the distance, they're like, this is really powerful, but we have to understand the regulatory positioning of this in order to figure out how we can interface it. When they try it, they're like, this product isn't there yet. Now, that doesn't mean the sector won't get there. And it doesn't mean the institutions don't think, well, like they remember why they were so excited to try it. And so I really don't want to try and imply that like institutions think the idea of DeFi isn't going to work. It's that the current user experience isn't there. And so instead, what you see almost exclusively when institutions want to get into DeFi, they don't touch it themselves. They do centralized trading with a centralized counterparty that themselves touches DeFi, whether it's an OTC counterparty, whether it's just a borrow lending desk or something else. The real flow of funds here is regulated institution lends capital at some interest rate, some other party, then goes and does the DeFi thing, gets a little bit higher interest rate. And that middle party, or maybe even there's one other party at this chain here, is one that actually understands how to interface with DeFi protocols.
Right. I mean, yeah, those entities have fiduciary responsibilities that they have to adhere by, and different suitability measures. So yeah, that makes a lot of sense. At least at this point, their gateway is a intermediary that knows how to access this realm of DeFi. That makes a lot of sense. So this actually makes me it reminds me of everything that happened with GameStop. It's the mix of retail institutions. Funny enough, during the crazy frenzy that happened, we were approached by market operators asking us, hey, is there anything we've learned from risk mitigation in crypto that we can apply possibly towards the traditional markets, right? Because what happened with GameStop is very similar to what we're seeing in crypto all the time. I mean, crypto is a retail first industry that all of a sudden allowed more and more right now institutions to come in. But on the other side of things, in the traditional industry, it was always institutionally first that allowed retail to come in order to allow for liquidation and whatnot. Do you think, Sam, that the traditional industry has something to learn from the crypto realm of things? In that sense?
Absolutely. And I think that like when you look at what that means, when sort of like GameStop went crazy, obviously there's high volatility, high gains, high losses. whatever, things happen when things get volatile. But you also saw a lot of platforms turn off buying of GameStop. And that is not something that should happen in crypto.
Right.
And it's not something that, well, okay, a lot of crypto exchanges actually did go down that day. Let's put that aside for a second.
That's which you
That's a
handled, and
separate
also
thing.
like that's right. Yeah.
Right.
Putting that aside.
Put that aside, FTX data, but and what happened was that there was, at its real core, there are a lot of issues with settlement in the traditional financial ecosystem. Things will only trade like 35 hours a week, which means that there's these giant gaps between trading sessions where things could move price a lot without any ability to close down positions. You have ACH and credit card transfers, which take 2 months to settle, and that entire time is basically a margin trade. If you're using those funds to buy something because you might charge back. And there's the fact that there's like 12 different companies involved. In a typical trade, the exchange, the clearing, the custody, the stocks, the fiat, the mobile app, the customer acquisition, those are all different companies. And no one can fully trust that the other is definitely exactly what they say they are. And so because of this, you have huge uncertainty over settlement in a lot of ways. And that just means that whenever things get volatile, everyone's worried someone else is going to fall down on the trade, right? That someone else is going to fail to deliver. And that everyone has to post this regulatory capital, which is capital on top of fully funding a position, because no one really thinks a position is 100% definitely fully funded. And that just causes serious issues. And you put on top of that there could be a 50% gap move overnight with no ability to trade in between. And so you have to have massive risk tolerance there. With crypto, everything is generally fully funded. If it's margined, it's explicit that it's margined with an explicit liquidation system that everyone understands, and 24/7 markets. And so you can close down positions whenever you need to, which means you only need to be planning for 10 minutes of volatility, not 10 hours. And all of those things mean that there's a lot of tools that the crypto ecosystem has to stay up and liquid in ways where the traditional financial ecosystem often has to shut down.
Right. No, yeah, and by the way, those I think merits of crypto, the 24/7 operational market, the accessibility of it, also creates more challenges that market participants have to deal with. I'm being signaled that we're nearing the end. So Sam, I wanna ask you kind of one question for closure that we like to ask in DACOM. What do you think we'll be talking about in DACOM 2022, and what do you think we'll be talking about in DACOM 2030? If this year's highlight is DeFi, what do you think is going to happen next year, and what do you think is going to happen in 10 years, give or take?
Totally. So, I mean, I think that we're going to be still talking a year from now about different scalability solutions. I think that it's not, the world hasn't figured out what's going to happen there yet. And I think that there's, whether you're talking about layer 2s, whether you're talking about side chains, about different layer 1s, and I think eventually the world's going to decide all these words are pretty similar to each other, and that like these grand distinctions drawn between them were thinner than people thought. And really everyone's looking at the same thing, which is a faster blockchain, and you can call it what you want, right? That's what all these things are. Right. But I think that that's not going to be fully resolved in a year, and it's going to be absolutely just the biggest open question. 10 years from now, I hope, and I have significant uncertainty, but my hope is that people are talking about all the cool new companies that are launching on chain. That's my hope. But if the industry fucks us up, then instead maybe people are talking about how it was such a disappointment that it never got huge.
What we have a minute, but I have to now follow up on this. What would you consider a big screw up of the industry? How can we now derail this? If it's what should market operators avoid? What should we pay attention to?
One big thing, we absolutely have to build great products with great user experiences. If we don't do that, nothing else is going to work. And right now, I think DeFi hasn't quite gotten there. That's something that just absolutely has to happen. And we have to solve scalability. That's the other big thing. Like, you just cannot be paying $30 for a transaction. And you cannot have a completely fractured ecosystem where no one single application can exist, because there doesn't even exist a single shard big enough for it. I think that those are the two big things that have to happen. And to the extent those don't, I think the industry is going to be kind of stuck, unable to grow or go mainstream.
That's great. And I guess that's also what's top of mind for FTX these days, which is great to hear. I know we are at time, and I think our MC, Elisa, I think, right, there's a panel coming after us. So Sam, I'd love to, take this quick minute to thank you for being here today. It's been great having you. Appreciate it. I know it's very late there, so thank you.
Thank you.
Bye-bye.
See ya.